Good evening. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective channel, where I help you make your dreams a reality. If you've seen any of my previous videos, you know that I love strategy and targeted strategy. And that awareness is key because I'm going to keep sifting through these financial memes and emails and everything else using our investment strategies along with some everyday down to earth common sense. This is an unedited video. Who knows what you'll hear in the background as I film these in my house. My cat is currently roving. If I'm not, let's see. So I am going to show our closed-end fund master list, but it's not my goal to get into all of that. So I hope to give you a brief overview of that system. And I am not a financial advisor. I am a financial strategist. So I'm not out to slander anybody. I'm interested in separating the good from the bad when it comes to financial advice because none of us want bad financial advice. So I will confess this might go long because there is a lot to get into or dig into today. So this is uh, my Pinterest page, and we're operating off this memes board. So towards the bottom of the list, we encounter this meme, and it looks pretty. It's arranged well, but it's not the best choice. At least it's not the best choice for us. Um, so instead of just taking this at face value, I put it into a spreadsheet. So I put every single company into a spreadsheet here, and I'll secondarily confess that I'm filming this in advance. So this is the data as of July 2nd, and I wonder what my cat is messing with in the background. And all of these are laid out as they're laid out in the meme. So two two funds a month, all the way through the end of the year. We'll get to my closed-end fund stuff in a minute. And this is the totals. So my advice is to pause the video as you go. Maybe pause the video as I go. So I'm going to hover over these little footnotes and then let you read a lot of it and let you think a lot of it, think about it. So these are the prices as of July 2nd. So MasterCard cost, dividend, annual dividend of just one share. So cost of the shares is, one share times the amount. And then the annual projected dividend. And even on a good year, when the Fed says the inflation rate is at 2%, I still think it's at least 3 or 4%. So all of these dividends leave you negative. So here's the advice. Dividend mania based on this is when they pay. And what I dislike, and I've said this before, what I dislike about these memes is they are not dated. So there's no way to go back and actually check the data as of the day they were made or as of the day they were posted. But what we have is what we have currently. So MasterCard, the ex-dividend, so the last day you can own the fund and receive the next dividend, is on a category 1 schedule. So that means it pays the first month. And this distinguishing factor is important. So when does it pay? So if it pays the first of the quarter, it pays quarterly, so it pays 4 times a year. So it would pay 14710. If it pays the second month, you're looking at 25811. And if it pays the third month, you're looking at 36912. Category 1, category 2, category 3, based on when they pay. So the ex-dividend date occurs on that 14710 schedule, but the pay date is on a category 2 schedule. So you have to own the company by a certain date in January in order to receive the next dividend in February, but you're not getting the dividend in January. That's a key difference. So that's a big deal. And then the footnotes or my additional notes. I initially searched all these stocks on the online investor, and then I got the dividend histories and really dug into the dividend histories on the Street Insider website. So pays on a category 2 schedule. So that's incorrect based on how the meme listed, right? Pays in January, actually pays in February. Lows, X dividend schedule, same thing. You confirm that you get the dividend on that category 1 schedule, but you actually receive the dividend on a category 2 schedule. That's a very big deal. So if this is your plan, you've missed a dividend from these companies for the first year. So this is wrong. Category 2 is better. So you have Apple, same thing. You can look at the share price, etc. down. Apple pays in February, as does Starbucks. You look at March, Home Depot pays in March. McDonald's pays in March. We continue to move across. Merck. So it's the 4th month. It's a category 1 schedule, but it does pay according to schedule. Walmart. Based on that Street Insider data, they currently pay an annual dividend. So it's advertised as a quarterly payer, but it hasn't paid quarterly since 2020. And even then it was erratic. It didn't happen on schedule. So it pays in April, but it might be the only time they pay in April. Or April might be the only time they pay. So this dividend is adjusted for that. Excuse me. So this annual dividend it's by share price. So you're looking at dividends per share times 4 times how many shares it is. And then this one is times 1 because it's annual. It's listed as quarterly, but it's paying on annual. Verizon pays on a category 2 like it should, 25811. Clorox does pay on schedule as it should, but the interesting point is this meme lists Clorox, and it also lists, where is it? P&G. Clorox's parent company is P&G. So you can own both. And you can own both, but you could just buy P&G and then they own Clorox. 3M, again, according to, say, Street Insider. Yeah, Street Insider. 3M, there we go, has not paid 4 times a year since 2022. Last year it paid 3 dividends. That's a big deal. So you're not getting one of the advertised dividends. In this annual dividend, look at that. 3 has not paid 4 since 2022, but I left it at 4. Lockheed did not make the June dividend payment for this year. Interesting. So this dividend reflects that. NVIDIA didn't pay dividends and had sketchy dividends for a while, but they say it's going to be 0.1 a share this year. They've paid it so far. Industrial properties, you can read, hasn't paid a dividend for a while. So they don't get factored in. Caterpillar pays on schedule. P&G didn't make all their dividend payments last year. Microsoft pays on schedule. J&J pays on schedule. JP Morgan didn't pay that 1 dividend, but pays it all since then. And Otherwise, it pays on schedule. AbbVie goes ex-dividend. So the last day you can own it, or the cutoff date of when you can own it and get the next dividend happens in October, but the dividend doesn't get paid until the next month. November, yeah, Accenture hasn't paid a dividend for a while. Costco has an erratic dividend schedule. I mean, it's projected to be category two. Uh, they've already paid a special dividend this year, but in recent past, they've not gone consistently with category two. United Health, dividends paid on schedule. Pepsi doesn't pay a December dividend. It's an alternating category three, and that it pays 369, but they don't pay 12, they pay 1. And it's been that way for a while. So based on this schedule, if you're hoping for a dividend in December from Pepsi, you're not going to get it because you won't get it until January. Now, at 1 share, I get that that doesn't look like a big deal, but the more you invest, the bigger deal it becomes. And if you've already looked to the right, you could be getting a better deal. So all of these companies, I mean, they're all top name, what a lot of people would call blue chip companies. They've been around a while. Supposedly they pay consistent dividends. They're not going anywhere anytime soon. So if you've bought 1 share of all of those companies as of 7/2, you would have been out almost $6,000. And for that $6,000, your annual dividend is not that much. And your annual yield sucks. So I propose some options or maybe some alternatives. We sold this closed-end fund. It's known as a blue chip powerhouse. It pays on that alternating schedule, 1369. Current dividends a share, 18. When you buy this fund, you get 11 of the 24 mentioned, plus some other stuff. So if you did this, based on our system, it's not on our current hit list. And I can show that with some different data. So this is the closed-end fund master, and I do weekly videos on this in a different playlist. These targets are based on the buy alerts. So the buy alert means that the current discount of each individual company for that company's data is greater than double the historical discount, and it's greater than the 5-year discount. Or maybe for a newer company, it's close. Like there's a little grace if your company or if a company is 3 to 4 years old. 2 asterisks would be $1 cost alert, and then 1 asterisk is we track it for any number of reasons. So if we scroll down to USA is here. We sold it last year. Its discount currently is does not put it on our wish list, but we also don't track it anymore. Now it sells a discount. I mean, this is data based on the end of last week. So, I mean, this is filmed almost a month before the video post. So, I mean, this is data, we'll say, from June 30th. Let's see. It does sell for a discount. It's known for doing well. It has an above average. And the current overall average for closed-end funds is about 8.3%. So it has an above average yield and it pays consistently. But I disliked the dividend reinvestment program. I like cash in hand dividends. Because I mean, I want to get paid a dividend. I want to get paid the reward for owning a company, but I also want to be able to take those rewards and apply them to what I want to buy. I don't want the company to reinvest those dividends for me. Meaning, say you had 100 shares of this. That's your, let's see, that's your dividend every quarter. They would pay you $18, and in a non-automated dividend reinvestment program, that would drop into your account and it would stay in your account. You can do whatever you want with it, spend it, withdraw it, whatever. But in a reinvestment, automatic reinvestment plan, it drops into your account. You get paid that, and then they take it back and they buy more shares of the company with it. Now, over time, it decreases your overall buy-in, but there are times when I don't want to invest in the companies that I already own because the current discount is not, it doesn't meet the metric. Versus the company I will show you next, I think. Let's see, NBXG is up here. Now, it's color coded in two different blues because we own it in two different portfolios. We own it inside the individual brokerage. We also own it inside our Roth. So I will hover over it. You can pause the video and read all the information. I don't want to read it to you. I hate when people read me information, especially that's already on screen. So I'll let you read. And then when you're done reading, if you buy NBXG, you get 9 out of the 24 funds. And it's the same data on both, like these comments are the same from the other one. Now, in doing that, NBXG has been, I mean, I'll let you read it at the same time. It's been around for about a year. Every company that starts out, I mean, we'll say almost every, there are a few exceptions. Almost every company that starts out with this really wide discount between what it's actually worth and what you're paying for it. And what you want to happen is for the overall company value to go up, but you also want the dividend to close. Or not the dividend. You want the company value to go up. You want the discount to close. So as the discount closes, the overall share cost goes up. The discount closes. That means the overall yield's going to go down because, say, back when we bought this company, we bought it for like this. So now, right, lower price, same dividend, higher yield. Versus now, backwards. There we go. Versus now, higher price, same dividend, lower yield. And the discount has gone down a little bit. It's fluctuated, but it's gone down a little bit. It's still well above average. It still meets our overall target at being 9% plus. And it also meets our target on discount. So since it's been around for about a year, I'm a little more gracious in how I control that target data. I mean, current discount is about 12%. That's less than the 1-year average, but that's okay. I mean, it's only a year old. I'm a little more gracious. If we go back to Liberty, this is the Liberty All-Star Fund page. You can get a full, if you really want, you search for All-Star Funds or USA Complete Portfolio, and it'll take you to this page and you can scroll through every single fund they own. I've already scrolled through. That's where I got the fraction, but you can scroll through and see all the different funds they own. So we'll close that tab. So we sold this closed-end fund. It's hailed as an amazing fund, but I want the dividends cash in hand. I mean, you could own it. So you get $18 a quarter. Excuse me. You get 0.18 a share times however much you own. You have 1,000 shares, you get $180 per quarter times 4, right? You catch my drift. But you never get to keep that and reinvest it based on your system. It's always reinvested for you back into the fund, regardless of what the fund's priced at. And that just doesn't fit our needs. So we sold it. We bought this fund, and it just happens to own 9 of the 24. And because I went ahead and looked at things. So USA owns these funds. Like of the 24, the ones in blue are what's already inside the USA fund. Same thing for NBXG. But the real interesting fund is this one, and it's on our wish list. Let's see. We're back to make sure I ETW. There are a lot of different ETs. So same thing. I'm going to let you read. I'm not going to read it word for word for you. Doesn't really respect you. It's always seemed very condescending to me to have to go to a meeting and be handed a packet and for somebody to stand at the front and read every single line and not even look at me. That bothers me. That's a waste of my time. Just hand me the PowerPoint and let me go. So pause the video and read this. And then we get into the details. So the current discount is, and for whatever reason we track it, kind of like this. So the current discount is 11.46. So the historical discount and the 5-year discount is about minus 5% off. And what that means is, in the grand scheme of things, if it was a 0% discount for every dollar in, it's a dollar invested. So if you get a discount, you're not paying full price for any number of reasons. So in this case, at 11% off, it's like paying 89 cents for every dollar invested. That's a good deal. And they they help fund the discount by doing this. It's a dividend that looks like it's rising. This is not the lowest it's been. It looks like it's coming back up. It pays above that 9%. So it's on target, pays monthly at above a 9% rate, and has a rising dividend. If it matters to you, it's a global fund. And pending your stance on the dollar, if trajectory holds, it looks like the dollar is going to lose value over the next couple of years. So I've seen others invest in global funds, so they get access to more types of currency than the U.S. dollar. It's also interesting that it's a global fund, since our Fed is still keeping our interest rates high, and you have different global players already lowering rates. So just tidbits, that's all. This is, there we go, ETW's fund. You can view all. So it does own, if we jump to the meme, it owns 16 of 24. And like USA, and I'm sure like NBXG, it owns more stuff. It was surprising to me how interesting this portfolio is. I mean, they own a ton of the list if you want to go off the list, but they also own a ton of other stuff. And by buying into the closed-end fund, you now have access to all this other stuff, which is pretty interesting. So I'm not going to scroll through the whole thing because it would take a while. So check it out when you have the time. Gosh, nighttime allergies are a killer. So if you kept the same investment at the share price of these closed-end funds as of July 2nd, this is how many shares you could gain of each of these funds. And with the same overall investment, like if you were going to plunk about $6,000 on all of these 24 companies to get quite honestly, a pissy dividend, a well below inflation dividend, then you could buy just one company and get a killer dividend and own pretty much all the same stocks, plus a lot more. So you would get this many shares of the company for the same cost, and it would give you this annual dividend. So pending style, like this is an automated drip. automated dividend reinvestment program. We didn't have a choice in the matter. I didn't like that. We owned this one. And with technology being on a tear, we have not put more money into it because it's so elevated from where we bought it. And then this one is still relatively down, which makes it kind of tempting, to be honest. And in the grand scheme of things, based on our parameters, this one doesn't meet the discount metric. This one does, and I say somewhat because that gap, like the overall average for the year is about 17. The current discount is about 11. There's leeway. It makes the list. But at the same time, it's not the same steep discount, but at the same time, that window is closing. So that's expected. Honestly, it's what you want as a shareholder. Increase value, hopefully increase dividend. And this one meets the metric. It's a portfolio in a can. They invest in everything. Not any, well, I won't say they invest in everything. It's all stock based. And that's kind of the one holdup. It's a very interesting portfolio, but with the herd or the bulk of the money into the market pushing money into stocks and into technology, I like to be where the herd isn't. And where the herd isn't right now is real estate. Well, in order, where the herd is not right now are bonds, loans, and real estate. So I've seen some good data that says the labor market's not as bad as projected. Maybe stocks are worth a consideration. And I've heard the opposite, that the herd is pumping money into stocks and elevating stock prices, and they're pumping money into technology and elevating the technology world or the technology stocks. So I like to be where the herd isn't, stuff that they're ignoring and the stuff that's really cheap to buy. Gosh, where you can just scoop a deal, and right now you can scoop some pretty good deals, pretty good discounts, and some pretty good dividends. So I'm not telling you what to buy, which I guess sounds wishy-washy. It's hard for me to look ahead and say, yes, we're going to buy that. ETW is on our wish list. I evaluate data every week, and I post closed-end fund videos every week, and I sift through the list and I post. In a perfect world, we would buy stuff every week. And I'll be honest, we don't buy stuff every week. But I post based on what I would buy if we were buying. And if we aren't buying, I say we're not buying. And I give you the same assessment, but just let you know that I'm not buying this week, or we're not buying this week, however you want to say that. And when we do buy, I tell you what we buy and the price points, and I reveal our entire portfolio. I mean, I don't give you the numbers and the access, but everything I show is what we have in the portfolio. So for our standard, we're not going to drop $6,000 into individual companies with really bad dividends and really bad dividend yields. We would much rather invest into a company structured like a mutual fund, but into a company who owns a lot of different stuff, regardless of sector. Like NBXG is a tech portfolio in a can. It's everything that would benefit from 5G technology. Blue chips, that's just an all-around portfolio, like a little here, a little there. You could be all energy, you can be all utilities, you can be all oil and natural gas, you can be, pick your flavor. There's an investment for that. Precious metals has one. So it depends on what you like. And I honestly just forgot my train of thought. Let's see if I can pick it up. No, that's the interesting fun of raw videos. Stuff comes up, I talk about it, and then I might lose my train of thought. But at any rate, the herd is currently pumping up the value of stocks and technology overall. So we have not bought more of that. You can make a case for us buying more of that because that bubble still expanding, and it seems like it has room to grow. Uh, I'm I'm quite okay with blue chip investments. I just don't like the automated drip, and this is tempting. It really is. I need to on my end. I need to do some more digging, and I generally say gosh, I process a ton of data every week. Uh, but I'll weigh the data, I'll weigh the info, and then I'll make the decision for the weekly videos. And even though that's on our wish list, it doesn't mean it's going to make the final cut for every video. So we'll see how it goes. But all I'm saying is just because it's a pretty meme does not mean it's your best choice of things. Bare minimum, the meme is not accurate. As I've shown by going through all of these different companies. And I get that I'm doing it on rapid replay at the moment. That's kind of what it is. All I'm saying is, look, if you're willing to buy a single share of every company, 24 companies, if you're willing to spend 6 grand on companies that are going to pay you crappy dividends for a year, from my standpoint, you're much better off putting that 6 grand into a company who's going to pay you a healthy, amazing dividend and a company who can pay it consistently and give you a ton of access, which really is a lot of less risk, right? But a ton of access and a ton of opportunity to see both the closure of that discount, so the price would go up, to pay the consistent dividend or raise a dividend, that would be amazing, right? And then you get a discount when you buy into the company. So it's win-win all the way around. So I do videos on specifically on why I like closed-end funds, and this gets close to it. Discounts. I mean, none of these are closed-end funds. Let's be clear. But in the closed-end fund world, you get to buy stuff at discount. You get to pick your dividend level. You get to pick your diversification within the portfolio. You get to pick your focus. You get to pick when they get paid. All of these pay monthly. All of the others pay quarterly. You want consistent monthly income, or do you want to hope you get paid on that quarter? So let's see, discounts, inbuilt diversity, low risk, insane dividends. Uh, you want a closing discount window. You want rising dividends. I think I've covered everything. So single stock investments and those memes look nice. They look pretty, but there's a better way. There's a way that will pay you. If you're going to plunk 6 grand on that, you can plunk 6 grand into any of these three and get a much more substantial dividend than this, just based on 6 grand. I mean, what would you? It's not a game of envy, right? It's not a game of, oh, look at that. It's not a game of envy. It's a game of, would you rather? Would you rather spend 6 grand and get less than $100 a year? Or would you rather spend 6 grand and get one of these annual dividends and have consistent monthly income? That's all I'm saying. Or maybe that's all I'm asking. So if you like the content, consider subscribing to my channel. Hit the like button, head over to Facebook, and check out my group there called Navigate Your Finances, where I talk about our entire 12-step system to financial freedom, or really the 12 steps of financial freedom or to financial freedom. Yeah, this video was fun. It took a while to make. It was fun digging into the data. It was fun getting into all the numbers. It was fun tracking down all the dividend histories and then trying to find closed-end funds that had as many of those companies as possible, plus some other stuff for you to think about. And I love making these videos, but I gotta say the the dividend mania, really the crappy dividend uh, memes, it just takes a lot of effort to combat that amount of information. And I'm at a section of the Pinterest board where there is a lot of information to combat. So it's fun. It takes some time, which is generally why I make these in advance. Uh, but again, if you like the content, consider subscribing to my channel. Hit the like button because it really does help push videos out. And then if you have any questions about closed-end funds, ask. And if you have any questions about our entire 12 steps, head over to Facebook or ask it on this video and I'll respond here. So I hope you have a great week. I hope everything is going well in your neck of the woods. And regardless of what you're up to, whatever whatever dream you're pursuing, wherever you are piloting your boat. I mean, ours is the pirate galleon, but wherever you are captaining your boat, that boat is not going to get there unless you direct its course. So your dreams are not going to happen on their own. It's not something you can think about and just manifest overnight. I mean, I get the whole manifest thought idea, just doesn't work financially. You cannot sit in a chair and meditate on finances and then wake up in a month and be where you want to be. It just doesn't work. You got to put in the work. Okay. You have to actively pursue your dreams and you have to make them happen. If it could have happened on its own, it would have happened on its own, but it hasn't. So make it happen. Everybody gets a rest day. Everybody feels tired. Everybody wants to sleep in occasionally. I get it. But do not sit on your backside and hope that your dreams happen at some point in this life. Get off your butt and get out there and get it done. Make your dreams happen because they will not happen if you meditatively manifest them every single day. It's just not going to work. Make your dreams happen. Get out there and get it done. I wish y'all a great week. I wish y'all success in whatever you're doing. And if you have questions, by all means, ask. So see y'all on another video. Bye-bye.